If you've ever been turned down for finance or you're worried your credit history is going to be a big problem, then this video is for you. Look, bad credit in property finance is one of the most misunderstood topics out there. People either don't realize how much it matters or they assume it means the door is completely closed. And you know what? The truth is, as usual, it's somewhere in the middle. The word depends always comes to mind when we're talking about finance, whether we're talking about planning, it depends. And it's just more nuanced than most people would care to admit. Welcome back. Today we are doing a proper deep dive into bad credit and property finance itself. So what are the different types of adverse credit? What do they all mean? How are lenders thinking about them? And critically, how the impact changes depending on whether you're going for a residential mortgage, a buy-to-let mortgage, a development finance application, or a bridging loan. Because here's the thing, bad credit isn't just one thing. It's a whole spectrum. A missed phone bill is very different to a liquidation. A CCJ from 5 years ago is very different to one that was just 5 months ago. And a residential mortgage lender looks at it very differently to a bridging lender or a development lender. So let's pull it all apart and get into it. First things first. Let's define what we're actually talking about, because bad credit covers a lot of ground. Missed payments are at the lighter end. These are exactly what they sound like. So it's very simple. You've missed a payment on a credit card, a loan, a utility bill, a phone contract. You've just missed a payment. You've got these monthly payments going out, direct debit, and for one reason or another, you've just missed one. One or two missed payments a few years ago on something minor. You know what, honestly? That's pretty manageable. A pattern of missed payments across multiple accounts, that becomes a very different story and a different conversation. So defaults are the next step up. A default is when a creditor formally closes or marks your account because you haven't paid. Typically, after several missed payments, it becomes a default, and it's a more serious marker than just a missed payment. And it stays on your credit file for around 6 years. CCJs are county court judgments. You may or may not have heard of them, but they're the next step up. And these are where a creditor has taken you to court over an unpaid debt and they have won. So the court issues a judgment against you. It sits on your file for like 6 years or so, and it can be satisfied, meaning you've paid it, or it can be unsatisfied, means that it remains outstanding. Now, the difference matters enormously to lenders, because you know what? They really, really want you to get those paid ASAP. And if you can get them paid, it can look really, really good at the very least. Then you've got IVAs. These are individual voluntary arrangements. These are a formal insolvency solution. It's an agreement between you and your creditors to pay back what you can over a fixed period, typically 5 or 6 years. And it's a fairly reasonable thing, but lenders don't like it for the most part. It's an alternative to bankruptcy, but it's still a significant adverse marker. Then you've got bankruptcy, and this one's a big one. This is at the serious end of the spectrum, a legal process where your assets are assessed and distributed among creditors. It has profound implications for property ownership and borrowing, and the effects last well beyond the discharge date. There can be some serious implications if you get to this point, including not being allowed to be a director of a company for quite a few years. And then there's liquidation, which sits slightly differently because it's a business event rather than a personal one. Now, when a company goes into liquidation, the business assets are sold to pay creditors. But, and this is a very big but, this is a very, very important part, how lenders view a director's personal creditworthiness after a company liquidation depends heavily on the circumstances. Was it a voluntary wind down of a business that had run its course? Was it an insolvent liquidation with creditors left unpaid, which can be considered way worse? Were there personal guarantees involved? And these things can take some time to prove and unravel. These are all very different stories. And that word, story, it brings me to the single most important thing I want you to take from this video. Context is everything. Lenders, at least the good ones, the specialist ones, the lower cost ones, the ones that you want to work with, don't just look at what's on your credit file. They look at why it's there, context. Because here's the thing, there's a world of difference between someone who racked up debt through reckless spending and someone who just missed payments because they were going through a divorce, dealing with a serious illness, was growing at a rapid rate and had some admin issues. I mean, that's a good problem to have for most people. people, or they were running a business that failed in genuinely difficult market conditions, whether it be 2008 global financial crisis, whether it be Brexit, whether it be COVID. These are all legit things. Life happens. It's complex, it's messy, unpredictable things happen to real people at the best of times. And responsible lenders, they do understand that. So for every adverse marker on your file, there are really 4 questions that matter. Number 1, what's the story? What actually caused this? Was it a one-off difficult period, or is there a pattern showing? Is there a clear, credible explanation? Number 2, how big is it? A £300 CCJ from a disputed utility bill is a very, very different risk signal to a £200,000 business debt. Size does matter in this instance. Number 3, how old is it? So something from 5 years ago carries far less weight than something from 5 months ago or 5 weeks ago. Time is your friend. Time heals all wounds. It shows you've stabilized and you've moved on, and you've got nothing else in the background. Number 4, have you behaved since? Have you rebuilt? Are your recent accounts clean? Is there evidence that whatever caused that thing in the past was a genuine problem and you've genuinely moved past it? And it's in the rearview mirror, you've no longer got to worry about it. These are the questions a specialist broker will help you answer very clearly, very honestly, and in a way that gives the lender the full picture rather than just the headlines. It's so important that you get this done correctly. Now, before we get into the different finance types, I want to call out a few things that lenders respond to particularly badly, because not all adverse credit is created equal. Missed mortgage payments are treated with special seriousness, and the logic is pretty hard to argue with. If you've missed payments on a previous mortgage, for example, your own home or a rental property, it doesn't matter, you've missed a payment on a mortgage, a lender's instinct is, if you couldn't pay someone else's mortgage, then why should we be so confident you'll be able to pay ours? It's almost a philosophical objection, and it's a fair one in my opinion. Even one missed mortgage payment can close a lot of doors, so you have to be super careful about this. But if you've got a pattern of them, it just completely narrows things considerably. It like shows that you're not serious about keeping up with repayments. It's a big red flag. Then you've got things like undischarged bankruptcy. It's another hard stop with most lenders. Until you're discharged, typically after like 12 months or so, mainstream and most specialist borrowing is off the table for you, unfortunately, especially for property. After discharge, options do begin to reopen, but you'll need time and a clean track record to rebuild that access into the market. Very recent adverse events are always harder than older ones, so you've got to remember that. A CCJ registered only last month, a liquidation that completed 6 weeks ago, lenders need to see some distance and stability before they can take a view. If there's not too much gap between when it happened and when you're applying for the loan, unfortunately, they just get nervous. And there's no magic number, unfortunately, but generally speaking, the further in the past that it is, the more options you have. And then, of course, you've got unexplained adverse credit. This is one that can hurt as well. Not because of what it is, it's because of what it suggests. If your credit file has problems and you can't or won't explain them, honestly, a lender has no choice but to assume the worst. So you have to be serious about getting the loan. You've got to be transparent. Like, you've got to package the case correctly. Get a good broker. Honestly, they'll be your best friend in this process, in this situation. Get them to present the information, be transparent, and you will have the best possible chance of getting something across the line. Before we get into the video, I just wanted to ask, do you have a property funding requirement or a property funding problem that needs a solution? If so, reach out to me at Merry Oaks Property Finance. Merry Oaks Property Finance is a brokerage that I set up in 2021 to support SME property investors and developers like myself, like you, with all of your funding requirements. So if it's development, bridging, commercial, anything property finance related, the more complex, the better as well, because we're very used to those types of things. If you're a portfolio landlord, whatever you might need, let us know. Reach out to us. Let's have a conversation and see where we go. Now back to the episode. I really hope you enjoy it. Right, let's go through the different types of property finance and look at adverse credit and how it plays out in each scenario, in each type of loan. Starting with residential mortgages. Buying your own home, everybody's over the moon to be able to do that. And I'll be very straight with you. This is where bad credit bites the hardest. Mainstream lenders, high street banks, and building society, all the high volume, low margin, low priced lenders that you really want to work with for a residential mortgage, They run heavily automated credit scoring systems. Almost any adverse market can trigger a decline before a human even looks at your case. A default from 4 years ago, bang, declined. A satisfied CCJ, a missed payment on a credit card, the computer says no. And here's the reality. The more serious the adverse credit, IVAs, bankruptcies, multiple CCJs, missed mortgage payments, the more restricted your mainstream options become, and it's just a fact of life. In some cases, literally, they become essentially non-existent. But that's the mainstream. It's not everything. The specialist residential mortgage market exists for exactly these situations. These lenders underwrite cases manually. They look at the full picture. They want to understand the story. It's important that you give them the story. They will typically require a larger deposit, often 15 to 25%. The 95% mortgages, they're just not going to be available to you. And sometimes they have higher pricing as well, higher rates, etc. All depends on the severity of the adverse credit, but the door is open. Importantly, those choices can be out there. They can be completely closed in these situations, but there can be some specialist options out there for short-term, maybe 5-year funding. And that's the point. The strategy many people use is this: they get onto a specialist product now, run it cleanly for 2, 3, 4, 5 years, and then remortgage back into the mainstream market at a much better rate once your credit is nice and clean. It's a stepping stone, not a destination. And what really determines whether that door is open and how wide that door is open, what universe of lenders you can go to, is the nature of the adverse credit, how old it is, how the story is presented, and which lenders do you go to. Buy-to-let mortgages follow a very similar pattern to residential, but with some useful nuances. The personal credit check still happens. Lenders want to know that the person behind the investment is financially responsible. So the same adverse markers create the same type of friction. It's very, very, very similar. Defaults, CCJs, IVAs, they all show up and they all matter to a buy-to-let lender. But buy-to-let lending is also heavily assessed on the investment's own merits. The critical number is the rental yield. Does the rental income comfortably cover the mortgage, and by how much? That's the interest coverage ratio, the ICR. That's what they're really looking at, but they're also looking at the background of the borrower. And it's, central to how buy-to-let applications are assessed. A property with genuinely strong rental fundamentals can partially offset concerns about personal credit in the specialist buy-to-let market. If the deal stacks up really well commercially and you've got a really good asset with strong demand in the area, a strong yield, and an experienced landlord, even with some adverse in the background, specialist lenders are often willing to take a broader view of that personal credit picture. And look, the specialist buy-to-let market is well developed by now. There are lenders who've built their model around landlords with complex financial histories, whether that's adverse credit, complex income structures, or large portfolios. So with the right deposit and strong property fundamentals, routes exist for those types of landlords and investors. Now, development finance, and this is where things start to look considerably more encouraging if you've got adverse credit in your history. Development lending operates in a fundamentally different way to mortgage lending. These lenders are not primarily asking, is this person's credit file clean? No, they're asking, is this project viable? Can this team deliver it? The asset comes first, the land, the planning permission, the build cost, the gross development value, what the completed scheme will be worth. These are the numbers that dominate the conversation. Your track record as a developer matters enormously, because you're going to be one that's delivering the scheme. And have you delivered schemes like this before? Is there a credible contractor and a competent team around you? Again, these are all important things. Now, if they've had lots of liquidations in the background, they might be asking those questions. But adverse credit is reviewed, a CCJ, a previous liquidation, even an IVA. Lenders will want to understand it. But in the context of a compelling project with an experienced delivery team, it's far less likely to be the decisive factor or a deal breaker. The deal is the deal. If the numbers work and the team is credible, lenders can often take a view. Now, there may be implications on terms, perhaps a slightly lower loan to cost, a lower loan to GDV, perhaps a requirement for additional security. These are all negotiating points, and a skilled development finance broker works through them with you. That's my forte. The reason why so many experienced entrepreneurs, including some who've had very difficult periods financially, find development finance accessible is precisely because the product is designed around project quality and team credibility, not personal credit perfection. That's just not as important. It's a factor, don't get me wrong, but it's secondary. And then there is bridging finance. And this is where, when it comes to adverse credit especially, you'll find the most flexibility of all. Bridging loans are short-term asset-backed loans, typically 1 to 24 months. On average, they're 12 months. And they're literally just that. They're used for bridging some from A to B. So if you've got bad credit, you can bridge to good credit. These are perfect tools to use in these circumstances. Bridging loans are used for buying quickly at auction, refurbishing properties, breaking a chain, acquiring something that doesn't qualify for a mortgage. They are fast, flexible, and they're secured against property. Because they're short-term and asset-backed, the risk profile is fundamentally different to a long-term mortgage. And a lot of them actually, you've got retained and rolled up interest, so they're not even checking your affordability or your ability to keep up repayments. If you've got missed payments, it's not much of a problem with bridging finance. The lender's core question is simple. Can I get my money back? When and how? And that comes down to one thing, the exit strategy. You have to have one or more exit strategies really clear, really well defined, so that they feel comfortable that to lend you the money and they're going to get it back. They want to know, how is this borrower going to repay this loan? Is it going to be through the sale of the property or a refinance onto a mortgage or a development loan? And if the exit is credible and the loan to value is sensible and the security property is solid, adverse credit becomes much less of a blocker. Most established bridging lenders will look past adverse credit if the fundamentals are sound. A past liquidation, old CCJs, even previous IVA, in the context of a clean exit and a strong asset, strong security, many lenders can work with this. Very recent or very large adverse events might affect pricing, might affect your LTV, but as hard blockers, just know there's always going to be funding out there with bridging loans. It's always either the pricing that varies or the LTV. So if you have significant adverse credit and you're exploring property finance, bridging is often where the most doors remain open. Now, I don't advise anyone to just jump into bridging finance. You need to do it very, very carefully. Speak to your broker, because if you don't have an exit, things can get messy quite quickly. So it's a very, very helpful tool. Lots of people use it, but if you use it badly, you can crash and burn. So speak to your broker, make sure that you understand the severity of it, and make sure that you've got a few exits to make sure get yourself out of it, because that's so important. So you've got adverse credit. You know which type of finance you're looking for. How do you actually get from here to getting funded? And the honest answer is you need the right broker. Not just any broker. Ask your broker, have you dealt with this type of case in the past? You need a specialist, someone who operates in the adverse credit lending market, someone who has real relationships with the lenders who will actually consider your case and do it critically. Do they know the business development managers? Do they know the underwriters? Do they know the CEO, the head of credit, the head of risk? These are the important people that they need to know to be able to talk to people to get your deal done. The lenders who work with adverse credit don't generally operate on a comparison website or from your local high street branch network. They work through broker relationships, and without a broker, you're often not getting to the conversation in the right way. But more than just access, it's about presentation. A skilled broker takes your situation and constructs a case that is honest, complete, and compelling. Remember what I was telling you, it's the story, it's the whole narrative, it's the context. It's really important that a good broker understands it and can portray it in the correct and best light. They're not going to just hide the defaults or the liquidation or the CCJs. They're going to explain them. They're going to put them up front and give a whole narrative behind it. They're going to provide that context. They frame your strengths alongside your history. An underwriter reading a well-packaged case with a clear, credible story is in a completely different position to one who just sees red flags with no explanation attached. And lender matching matters too. Not all specialist lenders are built the same. If you go to one particular one that has certain type of criteria versus the other, you're just going to waste a bunch of time, and you maybe get a bad score on your credit score rating as well because of the checks that they do. Some specialist lenders are more comfortable with CCJs than IVAs, and some vice versa. Some have specific thresholds on recency. Some are more comfortable with a certain loan size or a particular property type, a good broker who genuinely knows the market, knows which doors to knock on and which ones to leave alone. Then there's strategy. Getting the finance today is part of the job, but a good broker is already thinking about what comes next. How do you use this as a stepping stone? How do you build a clean record from here? Where do you want to be in the next 3, 4, 5 years? And what does the path actually look like? In the specialist world, many lenders can and do take a view on complex credit histories, but you need the right person in your corner telling the right story to the right lender. I want to be straight with you about something before we finish. Having adverse credit doesn't mean you can't get finance, but it also doesn't mean you'll get the deal on the terms you choose ideally. It just doesn't work like that. You may have to accept something that you're not 100% happy with, but it gets you to where you need to be. Success in this context can be very, very subjective. So for one person, success is getting the mortgage at all, even at a rate that you wouldn't necessarily choose if you had that clean credit. For another, it's securing a bridging loan that helps you move on as quickly as possible onto your next step. For a developer, for example, it's getting the deal funded on a project that stacks up. He's going to make profit at the end of it, despite a complicated, messy background. So just be realistic. A higher rate today, managed responsibly, can set you up significantly better with lots more options in 2, 3, 4, 5 years. And that's not exactly a compromise. That becomes a plan. All right, there might be a little bit of compromise in there, but certainly with a plan attached to it, it's a way forward. And whilst adverse credit is not necessarily a deal breaker, I won't pretend the outcome is guaranteed either. You just got to be super prepared for that. It can be a little bit of a 3 steps forward, 2 steps back type situation. It depends on the specifics of your credit history, the quality of your case, which lender is right for your situation, and what the market looks like at that moment in time. What I will say is, with the right approach, odds are almost always better than people think. There are options out there for you, and we're here to help you. Let's bring this home. If your credit is clean right now, protect it. Set up direct debits. Check your credit file at least annually. Experian, Equifax, and TransUnion. We've got a Check My File. We can send you the link. All these offer access. If it's your first time, I think the access is for free. And if you're ever in financial difficulty, speak to the creditors early before things start to escalate. Most would rather agree a payment plan than pursue legal action. And by the time it gets to legal action, you've got so many more fees. Honestly, it gets really, really uncomfortable. So if you already have adverse credit, here's your checklist. You have to know what's exactly on your file. Get your credit report, read it carefully, see what's there. When was that CCJ or late payment registered? Is it satisfied or outstanding? If it's a default, you cannot have a productive conversation with a broker until you know all the facts. And please pay outstanding debts where you can. It really, really does help. A satisfied CCJ, a clear default, these are materially better in a lender's eyes than the alternative. Gather documentation that supports the story behind the numbers. Get GP letters, doctor's letters, get redundancy notices, get business accounts, legal correspondence. The more evidence you have to back up the context, the stronger the case becomes. And finally, of course, please find a specialist broker, not just any broker, someone who's done this before, someone who knows the adverse credit lending market and who can present your case properly to the right lenders. The best outcome is always to avoid adverse credit altogether. Of course, that goes without saying, but if you have it, just don't fear not. Options exist. The specialist market is real, it's active. The specialist brokers are real, they're active, and it exists precisely to help you in situations like the one you're in. Just interrupting this episode to let you know that in the show notes, you will find a link to a free deal appraisal calculator. It's a buy, rent, refurbish, refinance calculator that I built. I used it over 550 times to find the first few high-yielding income-producing assets that I bought, and it gives you every single cost that you need in there to make it super granular. It also calculates your finance costs, and you can manipulate and tweak the LTGDVs up and down, the arrangement fees, the interest rates. You hit update model and it will tell you how much cash you are going to make on a monthly basis, as well as your return on capital employed. It also has a section for your incurred monthly expenses if you're doing serviced accommodation or HMO where all bills are inclusive. It's really comprehensive. I use it myself and I want you to use it. Now back to the episode. So to wrap up, bad credit is not one thing. It's a spectrum from missed payment on a phone bill all the way through to bankruptcy or liquidation, and how it affects your ability to access property finance depends enormously on what it is. What's the context? How big is it? What's the story behind it? And what type of finance you're looking for. Residential mortgages, feel it, you're going to struggle there the most, but the solutions are out there for you. Buy to let similarly is difficult, but not impossible. But as you get off to bridging and development, there are a lot more options there for you, and there's a lot more flexibility. Just remember, context, context, context. The story really matters. And if you've got a good broker, they will tell that story for you. And that can be the difference between a yes and a no. If you've been watching this and thinking that sounds like me, come find us, drop us a message, use the link in the description. No obligation, no judgment, just a proper conversation about what your options actually look like. And if this was useful, please give it a like. It genuinely helps more people find it who need to hear this. Hit the subscribe button, smash the bell icon, leave us a comment if you haven't already, because honestly, we're going to be back every Sunday at 10 o'clock. I do this for you, and there's a lot more topics that I could talk about. And if you're interested in me talking about one particular topic or the other, leave it in the comments below, and I'll get back to absolutely everybody. In the meantime, have a great day, and I'll see you on the next one.